Hello, this is Loeys, the first week of the new year, 2011. Well, I think we're making a good start of the year, despite somewhat weaker than expected U.S. payrolls. Add up all the data, are still better than what we had hoped, so creating decent upside risks on growth forecasts. It's allowed us also to raise growth forecasts for the world over the past few months. Nevertheless, we're still only talking about just over 3.5% growth for the world. Not that different from last year. More important is the composition. Last year was a bit of a dead cat bounce. A lot of inventory, stimulus coming from all over the place. This year is going to be a lot more based on services, the consumer, all edged on by decent jobs growth and incomes growth. So it's a bit more mature part of the cycle. It's a bit safer. Safety is important. It means reduced uncertainty. It's very important for risk markets that we all understand, have a common understanding where economies are going. So reduced risk, reduced uncertainty, near term at least, is good for risky markets. That doesn't mean that there is no more risk out there. The two major risk factors of last year are still here. The sovereign debt pressures, broad concerns about credit quality of governments. In the developed world, in the emerging markets world, they have their own issues with inflation. Both of these forces are still there. The way we tend to look at them, to treat them, is you stay away from them. You go around and you skirt these issues and you go towards other assets, less affected by sovereign funding problems in the developed world and EM inflation. Doesn't mean there's not going to be any contagion. We do have to accept that. So we expect some form of contagion, but not enough that it brings the world economy down. So it keeps us still long, risky assets. So what do you avoid? Well, what are the assets most vulnerable? Clearly, the European sovereign funding problems are spreading towards other countries to some degree. So yes, we're underweight in the periphery in Europe. We're seeing the impact on the U.S. municipal, the state and local market, both markets to be underweighted, I would say. I think broadly, you want to stay out of the fixed income, the government bond world, and be overweight the non-financial world. That means corporate credit, particularly high yield, and that means stocks. Similarly, I think it's a negative for the euro within Europe itself. EM inflation, it's going to have some impact clearly on both bonds and equities. I think you need to think in terms of trade, Latin American, EM, Asian bonds from the short side, not yet in the European time zones. Emerging equities is where we've all been piling into, starting to lag a bit. The flows are weakening a bit. There's a bit of concern over there, so tactically you want to underweight for the next few months, even though structurally long-term is still bullish, EM equities. So where does it leave us? That leaves us largely, the main position is we're long equities versus fixed income. So now you might say, well, every strategist is recommending that everybody's bullish. True, probably. But all strategists being bullish does not mean that all investors are overweight. When we look at all positions in equities versus bonds in the world, we think at best the global investor is neutral on equities in an environment where bonds are still very low yield against equities. So we do expect the next move is going to be a move from bonds into equities. Overall trading then, long equities versus bonds within the fixed income world, underweight governments, particular state and local authorities. Within credit, we're overweighting high yield, non-financial sectors. In currencies, we're underweight euro and sterling. In commodities, we're probably long. I think there's still heavy supply constraints. There's a particular sugar, copper, crude oil. We have long positions over there. And in bonds, don't think it's a real bad bear market. On average, we're on the short side, particularly in some of the Latin American and Asian bond markets. So overall, I think it's going to be a good year for investors with a lot of opportunities for tactical trading. Good luck.